to have an in-depth idea of how a company works. It is very vital to understand how financial analysts look and interpret the three important financial statements of a company, which are the balance sheet, the profit and loss statement, and the cash flow statement. In this simple but very strategic series, we are going to show you how a company operates by interpreting these three financial statements through the lens of a financial specialist. Before we proceed, it is very essential for us to understand what a transaction is all about and what components make up a transaction. A transaction occurs when you're either exchanging cash or credit for some goods, services, or financial assets. The amount of cash or credit we receive from a transaction forms part of what we own, which is called our assets. And the amount of cash and credit we use to pay for another person's goods and services forms part of the person's assets. If the transaction is carried out by cash, the exchange is settled and each person goes home with an asset. The money becomes the seller's assets as cash, and the goods become the buyer's assets as inventory. Given that cash is limited in supply relative to demand, there is a second way companies use to carry out transactions called crediting. How does this work? For example, you have Mr. Roland, a chocolate producer, who owns a chocolate manufacturing plant and does business with Mr. John, a cocoa plantation owner. Mr. Roland at a given moment wants to buy some cocoa seeds from Mr. John, something which he normally does every 2 months. Given that Mr. Roland does not have cash at the moment, this will not stop him from acquiring the cocoa seeds which is needed for the processing of chocolate. With a lack of money, Mr. Roland's chocolate company will carry out this transaction by getting into a contract with Mr. John's farm, which will permit Mr. John to provide the chocolate factory some raw materials on credit. And on the contract, it stipulates that the cocoa firm can pay Mr. John on a later date. This will mean that the two parties have carried out this transaction using a crediting system. From such a transaction, the chocolate company will receive the cocoa seeds, which will become her assets. And at the same time, she will be indebted to Mr. John's cocoa plantation. We can therefore conclude that Mr. Roland's cocoa processing company is liable to pay Mr. John an amount of money equal to that of his raw material. To both parties, such a transaction is business as usual because cash is limited in supply, and the only way to make sales become profitable and grow is by making sales on credit. Now, there exists a second scenario when Mr. Roland becomes the lender and some other company becomes the borrower. Let's say after processing the cocoa seeds to its finished product, which is chocolate, Mr. Roland provides this chocolate to Miss Shelley, who owns one of the biggest retail shops in Toronto. Miss Shelley also has a contract with Mr. Roland stipulating that she pays 50% of the price of a chocolate on receiving the products, and the rest of the payment to be made on a later date. This transaction between Mr. Roland and Miss Shelley creates an asset for Mr. Roland's cocoa processing company and a liability for Miss Shelley's retail store to be paid on a later date. The two scenarios at the end of the day create assets and liabilities for each party if the transaction is carried out with credit. On the other hand, if the transaction is carried out with just cash, the parties involved will go home with just their assets and no liabilities. The reality is that most companies will always use the combination of these two because cash is limited. Because of the limited nature of cash in the society, and given that every company's objective is to make more and more sales, increase their profit margin and grow, they are left with no choice but to give their goods on credit. It is the sum of hundreds of these transactions that occur between and within companies that can give us a simple understanding of how companies function. This brings us to the part where we try to understand how financial analysts look at these transactions. Financial specialists have summarized most of these transactions in 3 important financial statements to help us better understand how all companies work. Financial specialists have summarized these transactions into 3 important financial statements to help us understand how all companies work. The first financial statement is a balance sheet, which to a financier can be seen as a snapshot of a company at a given point in time. Next is the income statement, which is like the video recording of what a company did between 2 snapshots. For instance, you might have the snapshot of a company just before she was receiving financing from her investors to begin buying her raw materials. And you have another snapshot where the company is sharing dividends to her shareholders. This will mean that the income statement will help show you the recording from the time the company received the money from her investors, bought her raw materials from her suppliers, converting these raw materials into finished goods, selling these finished goods, receiving income from her sales, paying her workers, suppliers, rent and other costs, and then paying the government her taxes, interest rate to debt holders up until the period where she is sharing profits to her investors. And the last financial statement to be understood is the cash flow statement, which is that part which helps us to combine the balance sheet with the income statement to give it some good meaning. To an analyst, the cash flow statement can be seen as that part of the puzzle which helps you to narrate and understand the combination of the snapshots and the recordings in between to give it meaning. Now let us take a step back and look at the combination of these 3 financial statements brought together. Their combination will give us the ideal conceptual framework of a company. The upper part is basically the short run of the company, indicating the company's operations. This tells us that if properly managed, the operational activities of the company, which includes the short-run investment, will be greater than the short-term sources of financing. With such a situation, it is obvious that there will be high liquidity in a company, and such good company liquidity will contribute to the company's continuous growth. However, if poorly managed, the company will have inefficiencies within the operational part of the business, causing the lack of liquidity in the company, thereby leading to suspension of certain payments. The lower part of this conceptual company framework covers the long-run financing, taking into consideration the capital structure of a company and all the company's investments for the long run. Here, if our cost of financing a long-term investment turn out to be higher than the profits generated by the long-term investments, the company will witness a loss, and if such situation persists, we expect the company to arrive at a bankruptcy. On the other hand, if the profits generated by this long-term investment turn out to be higher than the cost of financing these long-term investments, then we know that the company is creating value. This can prompt the shareholders to reinvest their profits, leading to expansion and growth of the company.